Hi, I'm Kelly Zitlow. I've been helping people with mortgages for over 25 years. One of the things most people are confused about is what is the difference between a condo and a townhouse? And not only that, how does the financing differ? We're going to dive into that, and be sure to stay to the end for my number one tip. But before we get started, please do me a favor and subscribe to this channel. I have a true passion for home loan education, and I love helping people and guiding them through this process. So you'll want to be sure to subscribe and be part of this community. Okay, let's do this. So, condo versus townhouse, what's the difference? I've got a secret. It has nothing to do with what the dwelling looks like. I have thousands of these conversations, and a lot of people think, well, a condo is a particular look. Maybe it's something that's stacked, maybe it's something that is attached, but in reality, it has nothing to do with the way it looks. It has everything to do with the legal description and how that property was developed. So how do you know what the legal description says? Well, your realtor will be able to give that to you. The county assessor office generally will have some type of legal description associated with that property address. The thing that really gets confusing is that the multiple listing system, at least here in Arizona, it doesn't really have a condominium classification. So as our buyers are receiving listings of properties, it's going to say one of two things. It's going to say apartment loft, which is very likely a condominium, or it's going to say townhouse. But the issue is we see a lot of listings that come through that say townhouses, but they're not actually townhouses. They're legally defined and platted as condos, which means the financing is going to differ. Once you determine the property is a condo versus a townhouse, or a townhouse versus a condo, how does the financing differ and why does it differ? From a lending perspective, the dwelling type is very, very important because the home lending process is going to be different if the property is legally classified as a condo versus a townhouse. So that's right, based on the home loan program, every single loan program is going to approach a condominium different than a townhouse. Interest rates can be higher on condominiums. There could be additional cost involved on condominiums. There are going to be more restrictions in the CC&Rs that come with purchasing a condominium. So I'm not telling you not to buy a condominium. I am just here to tell you that from a lending process, if you're going to purchase a condominium and obtain a home loan, the lender is going to approach that dwelling type different. So why? Why? Well, the why is that when you are purchasing a condominium, you are having a percentage of interest in the overall project. That's what you're purchasing. So essentially, kind of think of it like airspace. You're purchasing airspace. But on a townhouse, you actually are purchasing a lot, meaning that there's dirt involved with what you are purchasing. So that's the primary difference. So when we think about condominiums, the reason that interest rates are higher, the reason that lenders are not just going to look at you as a borrower. They're actually going to go into the condominium project, have the HOA complete a questionnaire, and they are going to make sure that that condominium project meets the lending guidelines. This is essential. It's a very important part of the process. And there are some condominiums out there that do not meet the lending criteria, which means that you may not be able to obtain home financing if you're purchasing in a condo project using a home loan. And if that project doesn't meet the lending criteria, it may not be financeable. A couple of thoughts about this whole condominium approach. If you're purchasing a condo and you are using a home loan to finance the purchase, the lender's approach is going to vary depending on the loan type. So let's chunk that down. If you are using an FHA loan, understand that FHA has an approved list of condominiums. And so first, you're going to want to go to FHA's list and see if the condo project that you're interested in making an offer on is on FHA's list. That is great if it is. Now realize that with FHA, they also have kind of like an exception. So if there's a condo project that isn't on their approved list, there is something called a single unit approval process, and that's where the lender will then have to send the whole condo questionnaire to the HOA. The HOA will then complete it And based on that information, the lender will be able to determine if the condo project meets FHA's criteria. And if it does, then you may be able to use an FHA loan for financing a condo in that project, even though it's not already approved by FHA. Now that's a whole lot of steps, right? And it's a whole lot of steps to find out that, oh, nope, it doesn't meet FHA's criteria. So really, that's where we often will look at what are the conventional financing options, because they are not as detailed or stringent as FHA in many circumstances. But I'm going to get into that in a second. And one more thing on FHA, even if the condo project is on FHA's approved list of condominiums, the lender is still going to have the HOA complete a condo questionnaire. The lender is going to confirm that based on the condo questionnaire that the condo project still meets FHA's lending criteria. And then at that point, you're good to go with FHA. All right, so loan program number 2, VA. VA actually makes it really, really easy. With VA, you go to the VA list of approved condos. If the condo project's on there, boom, you're done. It's good. The lender can move forward. So number 3, the third type of financing, and probably the one that we use most often with condos, is conventional conforming financing. So that means Fannie Mae, Freddie Mac, they each have nuances to it, but pretty much it all falls in one bucket. And why do we use conventional financing more often than VA or FHA? Well, in a limited inventory market where it's highly, highly competitive, there is a lot more latitude with conventional financing because you don't necessarily have to have an approved list of condo projects. So there is a lot that goes on. So here's how it goes. With conventional financing, the occupancy of the borrower together with the down payment is going to drive the level of the review that the lender is going to do. So if we have a buyer that is purchasing the condo and it's going to be their primary residence and they are doing 10% or more down, then that is going to qualify the lender to do what's called a limited review, which is essentially what it sounds like. It's just limited information that the lender is going to reach out to the HOA, obtain, and do a gut check. Yep, it meets that limited review criteria, and the lender will move on with the loan process. But if the buyer is putting less than 10% down on a primary residence, then the lender is going to follow what's called a full review, which is pretty much all of the questions they asked in the limited review plus more. So it's just much more stringent. And I've got all of this information detailed in a really cool, like, one-page flyer on my website. So this will give you the nuts and bolts. So occupancy, meaning is it going to be a primary residence? Is it going to be a secondary residence or vacation home? Or is it going to be an investment property? The occupancy together with the down payment is going to drive the lender's approach. And if a full review is required, it's a lot of questions. And essentially, why are the lenders doing this? Why do the home loan guidelines require this? And honestly, it's to protect both the lender as well as you. Because again, you're investing in a condominium and you want to be sure, just like we do, the lender, that the condominium project is managed well, that it has the necessary budgets and reserves and everything required to maintain the property itself. So you have an asset that is not going to be jeopardized. And so that's why lenders are asking, and that's why it is important to you, even though it feels like a whole lot of something. Also, remember, on conventional loans, the interest rates are higher on condominiums than they are on townhouses or single-family detached houses. Now, they're not dramatically higher, but just know they're slightly higher, as is the cost of mortgage insurance if you're putting less than 20% down. So the loan program type is really going to drive the lender's approach with regard to condominium financing. Okay, how are townhouses financed? Well, a townhouse, remember, in that type of legal description, you actually are buying a dwelling that has a lot associated with it. So there are less requirements from the lending perspective that we're going to have to obtain from the HOA and document. But lenders are still going to want to reach out and get the blanket insurance information on a townhouse. So we understand what the insurance is being provided through the HOA. And from there, we can make sure that our buyers have enough coverage on the insurance that they're going to need to cover. Now, insurance is also really important, whether it's a condo or a townhouse. And so in most cases, think of what type of homeowner's insurance you're going to need. And it's actually called HO6 insurance. So it's a little bit different than a traditional homeowner's insurance policy. And the reason for that is that when you're purchasing a condominium or a townhouse, in most cases, the HOA is going to provide what is called blanket insurance, which means that their insurance as part of your HOA fee is going to cover from the studs out. So think of a wall, and in the middle of that wall, you're going to have framing and all that fun stuff. So from that middle of that wall outwards, outdoors, the HOA's homeowner's insurance through the blanket insurance policy usually covers that. Now, the HO6 insurance that you're going to want to obtain is going to be from studs in, meaning that it's going to be interior contents. If there's a flood or, a fire or theft or things like that, damage to the inside of the dwelling, that's where the HO6 insurance is going to come into play. So it is a little bit different when you're purchasing a condo or a townhouse and it comes to homeowners insurance. So my number one tip as a reminder is that the multiple listing service, which is the information of all of the properties that are for sale that your realtor is sending you, the multiple listing service actual classifications don't have a condo classification. So it gets confusing because your realtor may be sending you listings and it might say townhouse. So realize you want to reach back to your realtor. They know where to find the information to look at the legal description and really determine, is that a condo or is it a townhouse? Because it has nothing to do with the way that the dwelling looks in some cases. So that's it. Now you know the difference between a condo versus a townhouse or a townhouse versus a condo. Remember, it's always recommended to work with an experienced mortgage lender to help you through this process. If that's in Arizona, California, or Colorado, please feel free to give me a call. If you have questions, comment below, and don't forget to like, share, and subscribe.